Good morning, everyone, and thank you for joining us today. We're going to dive into the fascinating world of element-specific auditing, a focused approach that aims to enhance the accuracy and reliability of financial reporting. Throughout this presentation, we'll explore the scope, procedures, challenges, and the many benefits that come with auditing key components of financial statements. I'm excited to share insights that will help us better understand how targeted verification can make a significant difference in financial audits. Let's get started. When we talk about auditing specific elements, we're zeroing in on individual parts of financial statements rather than reviewing the full set. This focused approach allows us to direct our attention and resources to areas that present higher risks or greater significance within the financial reports. The selection of these specific elements is not random. It's based on factors like materiality, the complexity of the account, or any issues identified in the past. By concentrating on these key components, the audit process becomes more efficient and targeted, ultimately strengthening the reliability of the overall financial reporting. In essence, these targeted audits play a crucial role in ensuring that the most important parts of the financial statements are thoroughly examined and trustworthy. When we talk about element-specific audits, their main goal is to verify the accuracy and completeness of key accounts or items. Basically, we want to make sure the numbers we're focusing on are reliable and fully accounted for. Another important objective is to ensure these elements comply with relevant accounting standards and regulations, which helps maintain the integrity of financial reporting. These audits also play a crucial role in mitigating the risks associated with material misstatements, especially in critical areas where errors could have a big impact. Additionally, element-specific audits provide targeted assurance, which is particularly useful when a full audit isn't necessary or possible. Finally, by conducting these focus reviews, we help build confidence among stakeholders, giving them trust in important parts of the financial statements, and allowing any potential issues to be identified early on. When determining the scope of an audit, we focus on selecting the right elements, accounts, or items to review. First, materiality plays a big role. That means looking at the financial significance of each account or item to prioritize those that could impact the overall financial statements. Next, we consider risk assessment, which involves identifying areas with a higher potential for errors, fraud, or complex transactions that might need closer scrutiny. We also take into account prior audit findings, paying special attention to accounts with a history of discrepancies or weaknesses in internal controls. Additionally, regulatory and stakeholder requirements often dictate specific areas that must be included in the audit. Ultimately, the purpose of defining a targeted scope is to use audit resources efficiently, focusing on the areas that matter most and addressing key concerns effectively. Now, let's look at some specific audit procedures applied to various elements. First, we have inspection, which involves examining documents and records that support the balances in the financial statements. This helps ensure that the information presented is backed by proper evidence. Next is confirmation, where auditors communicate directly with third parties, such as customers or banks, to verify the accuracy of account information. Then comes recalculation, which is all about checking the mathematical accuracy of calculations to detect any errors. Finally, analytical review involves comparing account trends and relationships over time to spot any unusual patterns or discrepancies that may require further investigation. Each of these procedures plays a crucial role in building confidence in the financial statements. When conducting audits, there are several key areas we commonly focus on to ensure accuracy and compliance. First, cash audits are crucial. Here, we verify cash balances primarily through bank reconciliations and obtaining confirmations directly from the banks. This helps us confirm that the recorded cash aligns with actual bank records. Next, accounts receivable audits involve confirming balances with customers and analyzing the aging of those receivables. This helps us assess the likelihood of collection and identify any potential issues with overdue amounts. Moving on to inventory audits, these typically include physical counts to verify the existence of inventory, as well as valuation tests to ensure inventory is recorded at the correct value. Lastly, fixed assets audits involve inspecting the physical existence of assets and reviewing depreciation calculations to confirm they are accurate and comply with accounting standards. Each of these elements plays a critical role in providing a clear and reliable financial picture. When conducting element audits, there are several important challenges to keep in mind. First, scope limitations can be a significant issue. If the audit doesn't cover all relevant areas, there's a risk of missing related misstatements that lie outside the examined scope. Next, sampling risks come into play. Because auditors often test a sample rather than the entire population, the selected items might not accurately represent the whole, potentially leading to incorrect conclusions. Another challenge is the difficulty in detecting sophisticated fraud or manipulation, especially when the audit focuses narrowly on specific elements. To address these challenges, auditors use a combination of strategies. They conduct thorough risk assessments, apply multiple audit procedures, and maintain a high level of professional skepticism throughout the process. These steps help ensure that potential issues are identified and properly addressed. To wrap up, it's clear that element-specific audits are vital because they sharpen our focus on the most material accounts or items, strengthening the overall assurance we provide on financial statements. By honing in on these key areas, we achieve targeted verification that not only supports compliance and risk management, but also makes the audit process more efficient. For these audits to be truly effective, it's important to have a clear understanding of their scope, apply the right procedures, and address any inherent challenges that come up. When done well, element-specific audits significantly enhance the quality of financial reporting by delivering focused and streamlined audit efforts.